Hello, and thanks for joining us for this week's Signature FD Investment Audiocast. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start here with a recap of markets and the macroeconomic data from last week before turning to what we're watching in the week ahead and maybe a little bit into next year. So last week was a solid week for investors. Large cap US stocks were up about 1.7%, and that brought the year-to-date return to about 27%. It was encouraging to see some more broad participation last week, really led by the small cap stocks, which were up about 4.5% on the week. Now, when assessing the market's trend, we like to see a bull market that's confirmed by most stocks. So to see some strength in the small caps, that's a welcome development. And international markets were also generally participants last week as well. Now, one of the trends that we need to pay attention to is the bout of strength that we've seen more recently in commodities and in the US dollar. A major theme of this year has been stability in those two important variables. And last week did see strong gains in both commodities and the dollar. Now, it's not an issue yet, but if those trends continue, they could become a headwind to earnings in upcoming quarters. But for now, the trend evidence is still bullish. And the trend continues to be supported by solid economic growth trends. So last week, we got updates on housing, which can best be described as mixed. And on a positive note, home builder confidence increased and existing home sales also bounced. But housing starts are still weak and affordability continues to be an issue. We also got an early read on how November economic data is shaping up with an estimate of purchasing manager indexes for the service and manufacturing sectors. Now, those numbers beat estimates, showing comfortable expansion in general activity, and that was led by robust expansion in the service sector. Now, the manufacturing sector still appears to be in a mild contraction, but that part of the survey did improve somewhat. Now, we've also just about fully wrapped up the Q3 earnings season. Earnings look to have grown about 8.5% when I look at mid-sized and above companies, inclusive of large caps. Top line sales rose 5.3%, which is in line with nominal GDP growth in the third quarter. So, what that means is that companies were able to expand profit margins in Q3. Now, it's not a problem yet, but we do think that if there's going to be a major hiccup in the stock market uptrend next year, it could have to do with elevated analyst expectations for earnings in the next year. Generally, sales growth is going to track nominal GDP growth. So if we grow the economy about 4.5% next year, and then that's about what we can expect out of top line revenue growth. But analysts are still expecting double-digit earnings growth next year, which implies that companies will have to continue to expand their profit margins. So it's possible that they do that, but it's a risk worth monitoring. But for now, the corporate fundamentals remain solid. Now, as for what we're watching in the week ahead, we're going to get consumer confidence and home prices and also new home sales. So a little more data on the housing market. On Wednesday, we're going to get the personal income and outlays report. And that's a big one because it includes the Fed's favored PCE inflation data, but it's also going to give us a look at income and spending trends heading into the holiday season. Now, if there's a policy risk next year, it may be in the timing of various initiatives. If the incoming Trump administration focuses first on tariffs and immigration, while deregulation and tax cuts can't be achieved until later in the year or possibly even 2026, that could prove to be a growth drag. So the timing of policy will be something to watch. For now, it's a bull market until proven otherwise. And join us next week where we'll recap that impactful data from the upcoming economic reports. And we wish you all a happy Thanksgiving week ahead.